So I can share the PPT. Thank you, Rohit sir. So, in this session of the financial reporting, we are going to understand the we actually we see the fourth chapter. Okay, that is the reporting of assets, liabilities, and disclosure in financial statements. Okay, so in last sessions we understand the Indian Accounting Standard 2 finished, in which we understand the disclosure of inventories in financial statements. Okay, so we see the some of the types of inventories and how we disclose that inventories into the different financial statements. That is the balance sheet. We can say the income statements. Okay, another one is we can say the cash flow and the statements in the changes in equity. Okay, also in Indian Accounting Standard 16, that is the property, plant, and equipment. Okay, how we disclose the property, plant, and equipments in financial statements. Okay, that we understand in the last sessions. In this sessions, we are going to understand the Indian Accounting Standard 23, and that is the borrowing cost. And next one is the Indian Accounting Standard 36, that is the impairment of assets. Now, the first questions arises that is what is meant by a borrowing cost. Okay, we know that for doing a business, that the different organization wants they raise the funds. Okay, so whenever the organizations or the companies raise the funds, okay, they have to pay because they not get the any fund that is or we can say a free of cost. Okay, for to raise the fund, every company has to bear some costing. Okay, we know that whenever the company raise the loans, okay, they have to pay the interest on that loan. So that interest here is nothing but the borrowing cost. That is the cost required to borrow a funds, to borrow a huge amount to fulfill the fund requirement. Okay, so why the companies borrow the funds, we can say why the company take the loans or issue the bonds, because of uh, to we can say to buy the another property, to build we can say a manufacturing plant, to buy the machineries, to buy the equipments. Okay, so this is we can say the needs of the organizations, and that's why they raise the fund. Okay, so how this borrowing cost we can say how this interest we put into the financial statements, or that we are going to understand in the Indian Accounting Standard 23. Okay, so here are the we can say the guidelines here in the 23 is given for the borrowing cost. Okay, so which are the different types of borrowing cost that we are going to understand in these sessions. Okay, and how we make the entries of this borrowing cost into the financial statements, that we are going to understand in this sessions. Okay, so that the impairment of assets, that latter part we see in the second half of the sessions. Okay, so what is meant by borrowing cost? Okay, we know that the we can say borrowing cost is nothing but this cost required uh, by the companies, or the cost which bear by the company to raise the funds. That cost we called as the borrowing cost. So the we can say the borrowing cost should be treated as the that entry of the borrowing cost should be in the financial statements. Okay, because it is the type of one cost of cost that the company has to bear. Okay, so next one is we can see the core principles of the Indian Accounting Standard 23. Okay, so uh, we can say there are the two types of borrowing cost that is the company has to bear when the company capitalize is assets. Okay, whenever the company raise the fund, the purpose of the raising of the fund is maybe of the we can say the various purposes the company is having. Okay, to we can say to buy the property, to build a manufacturing plant, to purchase the equipment or the machineries. Okay, whenever the company we can say capitalize its assets, okay, then we considered then we put that we considered the expenses bear by the organizations or the company, that interest expense we called as the borrowing cost. Or otherwise, whenever the companies raise the fund, but if they not capitalize these assets, then that we called as the expense. Okay, uh, then okay, so whenever the borrowing cost directly attributable to acquisition, that means the whenever the company raise the fund, okay, so company is obliged to do some such a type of work that contributes in the capital of the company or in the assets of the company, then and then only that fund is benefited to that organization in the long run. Okay, if the company just raise the fund, okay, but they we can say waste that fund in the sum of the we can say the non usable things, then such a type of expenditure we not consider as the borrowing cost, we consider as the expense. Okay, uh, extra expense of the organizations. So when we considered that interest as the interest on the funds as the as the borrowing cost, when the company do we can say make the capital out of that fund. When the company raise the fund, it is oblique that the company has to capitalize its assets. Okay, so borrowing cost is directly attributable to acquisition. That means whenever company raise the fund, at least they use that fund from for the following type of the activities, like the acquisitions of the other organization. Okay, when the one organization raise the fund on some interest rate and they acquire some another company, okay, so that interest is paying by the company to raise that fund, that cost we called as the borrowing cost. Okay, okay. That means you all know that. Okay, so no financial institution, no individual investors can give you the fund free of cost. Okay, that means because the investor is doing investor in hope of the return of this fund. So that interest is the return for the investor and it is cost to the company, and that cost we called as the borrowing cost. Okay, so how much extra the company is paying to the financial institutions or the individual investors, that cost we called as the borrowing cost. Okay, so then company has to make some good decisions out of that raised fund. Okay, when the companies acquire some other company, it is we can say it increase the assets of the company or the assets of the organization. That means they increase the capital of the company if the one company acquire the another company, or when the company raise the fund and the company is constructing a manufacturing plant. Okay, okay, so the manufacturing plant gives in a long run, the manufacturing plant that gives the income to the company. Okay, so that is also we can, it is we also we can, it is the capitalizations of the fund. Next one is we can say the production. When the company raise the fund and they are doing the production out of that raise the fund, if they acquire some machineries, okay, in plant or the equipments. Okay, if they uses that fund for the production purpose, okay, so that production gives the income to the company in a long run. So that is also a we can say the good investment decisions. Okay, so all these type of investments by the company uh, from the raise fund, that assets we called as the qualifying assets. Qualifying assets are those assets which gives the company income in a long run. Okay, today if you are making any manufacturing plant, okay, so in the 2 periods of that we can say in the manufacturing process the company is not getting any income. Once the manufacturing plant is completed, okay, so after 2 years, okay, the income generation, okay, when company starts a production in that manufacturing plant, okay, the income generation we can say start after the 2 years. So that is nothing but the qualifying assets. So qualifying assets are those assets which gives a income to the company in a long run. So that means what that principle that is the borrowing cost is, whenever company raise a fund on some specific cost, if the company is bearing a cost, then company has to invest that fund in a such a type of assets that gives income to the company in the long run. That means the company has to, we can say, create the qualifying assets. Okay, so if the company is now doing that, that means companies, we can say, all the borrowings cost, that means all the funds they are raising, okay, that cannot be directly linked to the qualifying assets. Okay, they are not creating the assets, they are not creating such a type of assets that gives the income in a long run. Okay, then such a type of, so uh, then the company bears the cost. Okay, but the they are not doing a such a investment that gives the company income in a long run. So that we called as the expense. Okay, so all the other borrowing costs that cannot be directly linked to the qualifying assets are expense as incurred and maintaining the clarity in the financial reporting. Okay, so in financial reporting, we clearly mention that the raised fund we cannot use to create the qualifying assets. Okay, we spend that funds on some of the expenses, that is to pay the salary of the laborers, salary of the foreman, salary of the managers, to pay the electricity bills. So these are the expenses. If we raise a loan, that we can say waste the company in the such a type of expenses. Okay, so that expenses are not, we can say, beneficial to the company in a long run. Okay, okay, so the company has to make the entries in the financial statement as a expenses, not as the borrowing cost. Okay, next one is so this what are the borrowing costs? So what are the different types of borrowing costs? Okay, whenever company is requiring the funds, they raise the funds in a market, but we know that the fund is not we can say a freely available. The company has to pay some cost to the investor, because that cost is the return of that investor. In security analysis, we learn that why investor doing the investment, because of in the hope of the return. He is getting the return, so that's why he is doing the investment. That means whenever company raise the fund, they has to pay a cost on that. That cost we called as the borrowing cost. So what are the different types of borrowing cost? Okay, whenever company takes the loan, then company has to bear the interest. That means when a company takes the loan, in the company and the investors or the financial institutions, they mutually decide the interest rates. Okay, so the company has to pay the interest on that raised amount. So first one is the interest expense. So interest expense we considered as the borrowing cost. Okay, whenever the raise fund is used to create the qualifying assets. Okay, so that interest expenses we considered as the borrowing cost. Less next one is the lease interest. Okay, whenever the company takes any property, any land on a lease, and the amount they paid uh, to take that land or that property on lease, so that lease interest also we considered as the borrowing cost. Next one is, we can say, the exchange difference. Okay, whenever the company requires the fund in a one currency of okay, then the exchange rate difference between the two currencies is we considered as the borrowing cost. And that for example, if we raise the dollars in 2025, okay, so today's exchange rate is 88 point something, 88.60. But when we paid in the 2030, if the exchange rate it might be a 91 rupees, then that near about the 3 rupees is your borrowing cost. That means company bear that much that exchange rate plus interest. So that is a total borrowing cost for the company or for the organization. So these are the major types of the borrowing cost. Okay. Now, what is the qualifying assets? Okay, I told you in some of from last few minutes that company creates the qualifying assets. But what is the definition of the qualifying assets, and what are the different assets we called as the qualifying assets? That is the main questions. So an assets that require the substantial period of time to get ready for its intended use or sale. Okay, that means that assets takes the time. Okay, so that assets requires the, we can say, some period of time, this substantial period of time, near about more than a year to, we can say, the 5 years or the 10 years, okay, to get ready for its intended use or sale. Okay, when we know that if we are we can say construct the building in Pune city in hope of the selling of the flats. Okay, so that it takes near about the 5 to 6 years. So after the 5 to 6 year, your building is ready for a sale. Okay, so that we called as the qualifying assets. Okay, to construct that building, might you have take the loans from the banks, from the individual investors, and then you construct that building. Okay, when you sell the flat in the building, you gets the income after selling the flats. Okay, so this is how the qualifying assets actually gives the company income in a long run. After some period of time, it takes the time, but that qualifying assets gives the income to the company and justifying the capitalization of the associate borrowing cost. Okay. Okay, so the justification to the borrowing cost, when the, we can say, raise fund, if you use to create the qualifying assets, then and then only we considered as the justifying the capitalization. Okay, if we waste the raise fund in the, we can say, the other expenses. Okay, so that will not create the income to the company in the long run. Okay, so now the company has to bear the cost. Okay, and the company is not having the income on the raise fund, so it is not justifiable to the company, because the fund they raise by the company for the income motive, because we know that company raise any fund, so there is a, we can say, a motive behind that, we can say, that fund, uh, raising of the fund. Okay, so we can say that all the such a type of assets that creates by the company or the organizations in intended to use to create the goods and services. After selling the goods and services, the company gets the, we can say, a specified income, or when they sales these such a type of assets, they'll gets the income. So the manufacturing plants and facilities. Okay, so manufacturing plant we called as the qualifying assets, because we know that we can implant the machineries, equipments in that manufacturing plant, and we can start manufacturing goods in that plant. Okay, for example, if we uh, if you start the factory of the pen. Okay, so for that purpose we have to make some manufacturing plant in, we install the machinery, and then we start production of the pens, and when we sell pens into the market, okay, so that creates the income for the company. So that manufacturing plants and the facilities we call as the qualifying assets. That means that assets creates the income for the company, income for the organization in a long run. Next one is, we can see, the power generation infrastructure. Okay, we know that in power plant, the huge equipment of the infrastructure is required. Okay, to generate the electricity. But once the plant is ready for the electricity generation, they create the income for that electricity plant in a long run. Okay, so that intangible assets under the development. That means if the company raise the fund and the company is doing the research and development, or they, we can say that that they use that fund for their to increase the goodwill in the market. Okay, or to get some patents. Okay, so all these, if they are using the raise fund for this purpose also, that is to create the intangible assets. Okay, so if the goodwill of the company increase in the market, automatically the sales of the product of that particular company in the market increases. So that will be benefited for the company in the long run. So this is so intangible assets are also we can consider as the qualifying assets, because it is benefited to the organization in the long run. Next one is we can say the investment properties. You know that whenever company use that fund for the investment purpose, because they are generating the return in long run. Next one is we can say the some biological assets, such a type of assets that creates the income for the organization in a long run. So all such a type of assets we called as the qualifying assets. So what is the concept behind the borrowing cost? That whenever the company raise a loan, whenever company takes the any property, any plant on a lease, okay, or we can say whenever a company takes the any foreign investment, okay, they okay, the company must invest all these funds in the qualifying assets. Then and then only we can say that the borrowing cost is justifiable to the companies, because the company has to pay has to bear the borrowing cost. There is no options for that, because the if the investor gives the fund to the company, so he invests in hope of the return. Okay. So there is no option for the interest rates, or we can the lease payment, or we can say the exchange expense. Okay, so the company has to bear that. But out of that raise fund, if the companies, we can say create the capital of the we can say the qualifying assets. Okay, so then and then only we consider the cost on that fund is the borrowing cost. Otherwise, we will consider it as a expense, other expense. Okay, next one is we can say the what are the different assets we excluded from the capitalizations. That means if the company is raising the funds and they create the assets, but that assets we cannot consider as the capitalization. So capitalization is nothing but it increases the such a type of assets in the companies that is helpful for the companies to generate the income for the organizations. Okay, so just some of the type of assets we cannot consider as the capitalization. So which are those assets? We can say the financial assets we cannot consider as the capitalization. Okay, we only consider that is the plant, machineries, manufacturing plant. We can say the goodwill, equipment, machineries, all this we consider as the capitalization. So financial assets we cannot consider as the capitalizations. Okay, because we cannot create any goods and service with the help of that financial asset or the financial instrument. So all the financial instruments and the investments are excluded from the borrowing cost capitalizations. Okay, whenever the company raise the funds, okay, so they cannot we can say use that fund to purchase the financial assets. Okay, when the company can invest in the financial assets, when they having the extra revenue, extra profit with them. You can say the profit reserve. Then and then only they can buy the financial assets. So the financial assets we cannot consider it as the capitalizations. Next one is we can say the routine inventory. That means the basic raw material that we use for the production purpose. So that also we cannot consider as the capitalizations. And all the ready assets. Okay, that means the ready assets are such a type of assets that does not need the value addition for selling purpose. Okay, so that type of assets we called as the ready assets. The assets are that already ready for the intended use or sales. Okay, no additional development or the additional value addition is not required for such a type of assets. So that assets we cannot consider as the capitalizations. Okay, okay, when to capitalize the borrowing cost? Okay, when we consider that cost as the borrowing cost. Okay, when the we can say when the capitalization begins. That means when we raise the fund, we start we can say to build a manufacturing plant. Okay, so from that day one, we start calculating a borrowing cost on that loan. Okay, the capitalization begin when expenditures for the assets are incurred, borrowing costs are incurred. Okay, so whenever we raise a loan and we use that loan for the manufacturing a plant, so from that day we start calculating a borrowing cost. Okay, and activities to prepare the assets for use are actively in a progress. Okay? If the manufacturing plant we can say is the manufacturing is interrupted by some reasons. Okay, if we can say some of the reason, maybe the labors are not available. Okay, we can say the nature is not good, some of the government interruptions. So in that case, we suspend the borrowing cost. That means stop calculating the borrowing cost. Okay, so that cost, the interest we are paying on that loan, we consider it as the expense, not as a borrowing cost. Okay, so the capitalization must be suspended during the extended period when active development is interrupted by some of the causes, ensuring cost. Okay, so that then at that time we suspend the borrowing cost. Okay, so what the time period of the actual manufacturing, uh, what is the interest on a loan for that time. Okay, so that value we put in the financial statements. Okay, in financial statements like the balance sheet, income statement, cash flow statement, and changes in the equity statements. Okay, next one is the, we can say, the this cessation, when we cease the borrowing cost. Okay, once when we start manufacturing a plant, and once the manufacturing plant is ready, that means the product, the manufacturing of uh, or the construction of the manufacturing plant is over. Now plant is ready for the production purpose. Now we can implant the machineries and equipments in that plant, and we can start the production. Okay, so at that point of time, we can say we staff the borrowing cost. We further, if the interest is we can say we pay after that construction of the manufacturing plant, we consider it as the expense, not as a cost. Okay, so the capitalization ceases when substantially all the activities necessary to can say they prepare the assets for use or sale or complete. Okay, once that complete, till that time period we consider it as the borrowing cost. Okay, so measuring of the borrowing cost for the capitalizations, how we measure the, we can say, the borrowing cost for any capitalizations. So we can say for the general borrowings, apply the weighted average capitalization rate to expenditures on the qualifying assets based on the entity's general borrowing pool uh, and the outstanding amount. Okay, so we know that we take the different loans, or we take the different funds from the different destination to fulfill the fund requirement. Okay, because we know that in company, whenever the company requires the fund, we cannot get all the funds from the at the one place. Okay, we have to raise the funds from the different financial institutions. Okay, from the different individuals. Okay, the interest rates may be different. Okay, so your total weight. Okay, we calculate the weights for the of the weight of the different loans, and on that basis we can calculate, okay, so how much part we use for to create the manufacturing plant, to create the qualifying assets, and according to that we calculate the borrowing cost. And we can say some specific borrowings, if we do that, calculate the actual borrowing cost incurred on funds borrowed specifically for for qualifying assets, less any income earned from the temporary investment of those borrowed funds. Okay, whenever we raise the funds, and out of that all the funds, if we made any investments and we raise the funds, so we have to minus that income from the borrowed fund, and on that amount then we calculate the borrowing cost. Okay, so this is how we calculate the cost and put that cost into the financial statements. Okay, uh, so this is what about the Indian Accounting Standard 23. That actually, so here is the one, that is the impact of the foreign currency borrowings. Whenever we borrow the foreign currencies and the exchange rate goes up, okay, so the company has to bear the exchange rate. We can say the increase of exchange rate cost. So that cost we also make entries in the financial statements. So here are some requirements are given under the Indian Accounting Standard 23. How the companies made the disclosure, that way these are the mandated by the Indian Accounting Standard 23, that this disclosure must be there in the financial statement. So what are these disclosure? That is the capitalized amount. That is the total amount of the borrowing cost capitalized during the reporting period, providing the transparency on assessed cost compositions. Okay. Okay. So how much capitalization of assets the company is done? Okay. And on that capitalized assets, the how much the companies pays the borrowing cost. Okay. So that's the that value must be there in the financial statements or the accounting policy, the clear explanation of the accounting policy adopted. Okay, which accounting policy is used by the company to disclose that we can say borrowing cost, and their clear explanation must be there for the borrowing cost and the methodologies applied. Okay, which methodologies applied? So that should be clearly mentioned in the financial statement. That is, all these we mention in a note. Okay, we actually see that how we put the note in the financial statements. Next one is we can see some of these circumstances, that is the detailed description of the circumstances under which the borrowing costs are capitalized and the rationale applied. Okay, when so some of the circumstances mean when the companies require the fund for what purpose. Okay, so these are some of the conditions that must be specified in the financial statements. So these are, we can say, some of the requirements as per the Indian Accounting Standard 23. Now the next accounting standard is the 36, that is the impairment of assets. Okay, the we can say the impairment of assets we can understand from the word that is impairment of asset. That means, uh, for example, if I purchase any machinery at the value of, we can say, the 10 lakhs. Now, what is the value of the machine in my financial statements is the 10 lakh rupees. But we know that because of the depreciation, the value of my machinery degrades over a period of time. That means every year the value of my machinery decreases over a period of time. Okay, so if I minus the depreciation for 4 years, if I say the depreciation is 1 lakh every year. Now, after the 4 years, what is the value of my machinery? Is 6 lakh. Now, I put that 6 lakh value in the different financial statements. That is in balance sheet, in income statement. Okay, I value that machinery for the 6 lakh. But when I sell that machinery into the market, I only get the 4 lakh rupees value. Okay, that means I consider that machinery's value is the 6 lakh rupees, but actually in market the value of that machinery is only the 4 lakhs. So that is the 2 lakh difference. That means the value I mentioned in the financial statement, 6 lakh, is, we can say, it is the incorrect value. Okay, because in market value, in market the value of the machinery is only the 4 lakh rupees. So that difference we calculate as the impairment cost. Okay. So how we can say how this scenario we mention in the financial statements. So for that purpose, we have the guidelines given by the Indian Accounting Standard 36. Okay, so in, we can say, the Indian Companies Amendment Act 2015. Okay, so as per the Indian Accounting Standard 36, how the impairment of assets. Okay, how we mention that scenario into the financial financial statements. Okay, so objectives of the Indian Accounting Standard 36, that is the assets value ceiling. Okay, that means the ensure that the assets are carried at no more than their recoverable amount. So what is mean by recoverable amount? When I sell my machinery, my equipment, my plant, whatever the qualifying assets I have, if I sell that into the market and the value I received from the seller, so that value we called as the we can say the recoverable amount or the recoverable value. That means what I mentioned in what the value I mentioned for uh, that machinery or that equipment in the financial statements, that should be a correct one. That means that Indian Accounting Standards 36 ensure that the assets are carried in the financial statement, that is the carrying value. Carrying value, the carrying value of the assets means the value I mention in the financial statements for that machinery, for that equipment, that value I called as the carrying value. Okay, but when I sell the same machinery, same equipment into the market, the value I get from the market, it is the recoverable, we can say a recoverable amount or the recoverable value. Okay, so the difference between the carrying value and the recoverable value, that is the, we can say, the impairment of the assets. Okay, that means there is a difference in the value of the assets. Okay, if I go with the we can say the carrying value, that means I told you initially the value of my machinery is 10 lakhs. My depreciation every year by the straight line method is 1 lakh. So after the 4 years, the value of my machinery is 6 lakh rupees. So the 6 lakh rupees is the carrying value. So that value I carry in the financial statements. Okay, but it is a carrying value that I put as per the mathematics in account. That means the we can say the fair value minus depreciation. So that is a carrying value. But when actually we are going to sell that same equipment, same machinery into the market, I only get the 4 lakh rupees. So the 2 lakh rupee is a difference. So if I go with the 6 lakh rupees, then it is not the realistic financial statements. Okay, so that financial statements may misguides the investors, may misguides the management. Okay, okay. So whenever or the value we are getting of the gross profit, we can say the operating profit or the net profit is the wrong values, because of the we can say the value, the carrying value is more than the actual market value of that equipment or that asset. Okay, so because of that, what that Indian Accounting Standard 36 says, that companies must have to mention the recoverable value or the difference between the carrying value and the marketable value into their financial statement for the clear understanding of the different stakeholder of the company. Okay, so then and then only the who reads the financial statements can clearly understand that there is the difference between the carrying value and the market value, and then the different stakeholders can take the good decisions from that financial statements. So we can say from that we can say from that carrying value and that market value we can recognize the loss, how much loss this company is having with that prior, with that value difference. That is establish the clear guidelines for recognizing the impairment losses when an asset's carrying amount exceeds its recoverable amount. That 2 lakh rupees, I told you that 6 lakhs minus 4 lakh is your impairment loss. Okay, and that impairment loss we that impairment losses we considered as the loss to the company. Okay, so that ensuring the timely and the accurate reporting. So the accurate reporting of that carrying value and that marketable value, or we can say the recoverable value, should be clearly mentioned. So they then and then only company have the realistic data, or we can say the actual data of their financial position or their financial parameters to with them or to their different stakeholders. Okay, so what are the key definitions in Indian Accounting Standard 36? First one is, we can say, the carrying amount. Okay, so carrying amount is the amount that actually mentioned in the financial statements as per the we can say as per the some of the rules of the accounting. But so what is the recoverable amount? When the assets we can say we actually sales into the market, the value we can say offered by the seller, that value we called as the recoverable amount. That is the higher the assets fair value, less cost to sell its value in the use, representing the maximum value recoverable from the assets. So that's value we call as the recoverable amount. And the difference between that carrying value and the recoverable value, that is the impairment loss. That is the 6 lakhs minus 4 lakhs. I told you that 2 lakh is your the impairment loss, that is the amount by which the carrying amount of an asset exceeds its recoverable amount, require the immediate recognition. So that 2 lakh loss we recognize. Okay. Cash generating unit, that means the smallest identifiable group of assets that generate the cash inflows largely independent from the other assets or the group. Okay, some of we know that the some of the parts of the machinery we can sell into the market separately, and we can generate the cash from there. So that is the cash generating units. Okay, so some of the indicators of the impairment. So why this difference is there? That is the, we can say, the difference between the carrying value and the recoverable value. Why this difference? Okay, what is some of the external factors and the internal factors as having the impact, and due to this we see that impairments of the assets. Okay, some of the internal factors first we see, that is the evidence of the obsolescence of the physical damage. Okay, if your machinery is physically damaged, okay, automatically you will not get the we can say the real value or the fair value for your machinery, for your assets into the market. Okay, so and because of there is a difference between the carrying value and the marketable value because of that damage. And because of the damage, the sellers offer you the less value for your assets. Next one is the significant change in the assets uses. Okay, if we can say the new machinery is coming into the market, and the significant changes in the assets. Now the new machinery, advanced machinery is available into the market, then automatically you will not get the fair value for your assets, and then there is a difference between the market value and the carrying value. We can say the underperformance relative to the expectations. If their machinery or the asset is not performing as per the expectation of the seller, then he will not offer you the we can say the good value for your assets. Okay, automatically he offered you the less value, and there is a difference between the carrying value and the recoverable value. Next one is the reconstruction and the discontinuation plans. Okay, Uh, so in such a condition as well, you will not get the good value for your assets. So these are some of the internal factors which causes the impairment losses. Next one is the external indicators. We know that the significant decline in the market value beyond the normal use. Okay, if the market, we can say the market trend is not go with the we can say the that assets. That means if the market is in the recession or the depressions, or we can say is not market is not go well with that assets, automatically the seller not offer the good value to you. So there is a difference between the carrying value and the recoverable value. Next one is the adverse change in economic environment. If the economic environment is changed, if we can say the peoples in the economy is not having enough cash, enough liquidity with them. Okay, so in that condition, that the seller not offered the good value for your, if the market condition is not good. Next one is the increase in the market interest rate affecting the discount rate. Okay, if the market interest rates are increases, automatically the borrowing capacity of the company or the who is the seller, who is the buyer of your asset, not having that we can say enough cash, he not offer you a good value. Then the competitive market developments, if the we can say the number of machineries or the number of assets of the same type is already available into the market, then automatically the prices of your assets in the market gets decreases, because of we know that the value of any assets or the any product goods, it depends upon the demand and supply. Okay, if the supply is much into the economy, that means the same asset is available into the market in abundance. Automatically, the value of your assets into the market gets decreased. So these are the factors which affect the impairment losses. Okay, so these are the testing for impairments. When we test that the value of the asset, when we find that there is a difference between the carrying value and the recoverable value, that is the annual requirement, that is annually each and every company we can say they uh, calculate the impairment losses on the each and every assets. That is the annual requirement, that mandatory annual impairment testing for the intangible assets with the infinite. Okay, so those who are the intangible assets as well as the tangible assets. Okay, so the annual calculation must be there. Next one is the indicator based testing. Okay, so other assets are tested for impairment when the specific indicator suggests uh, the carrying amount. Okay, so whenever if there are some of the market indicators that if the specific the value for the specific assets the market gets decreases, okay, the company is we can say is having that assets. Okay, so then they can calculate the impairment losses. Next one is the CGU assessment. When individual asset testing is not feasible, assessment is performed at the cash generating unit. Okay, so these are some of the methods in we or we can say conditions when we calculate the impairment losses. Okay, so measuring recoverable amount. Okay, so what is the meaning of the I already told you that what is the recoverable amount. That is the market based measurement reflecting the amount obtainable from the disposal. When we sell that asset into the market, the value we recovered from the buyer. Okay, so that amount we called as the recoverable amount. Okay, so recognizing and reversing the impairment losses. Okay, when we recognize the impairment losses. Okay, so immediate recognition must be there. That means when we prepare the financial statements, that is the balance sheet, income statements, cash flow statements, that if the impairment losses if the impairment losses is there for any assets, okay, so that must be clearly mentioned in your financial statements. Okay, or if uh, if the negligence towards the impairment of the assets, then your financial statement is, we can say, is having the error. We can say it may be having the estimation errors, or we can say uh, that estimation errors in your financial statements. So in such a case, you may have to we can say the made your financial statements again. Okay, but that Indian accounting standard 36, what it tells us that the we can say the impairment losses must be clearly mentioned annually. That means the annual calculations of the impairment of the assets, and it should be clearly mentioned into the financial statements. That is the immediate recognition. That is the impairment losses must be recognized immediately in profit or loss, ensuring the transparent reporting in of the assets value declines. Okay, so how much losses the company is facing, that must be clearly mentioned. Or the reversal condition, that is the reversal of the impairment losses is permitted when the recoverable amount increases except for the goodwill which cannot be reversed. Okay, in some of the cases it might be seen that sometimes the carrying value is, we can say, more than the recoverable value, but because of some market conditions or the economic recovery, that the your recoverable value gets increases because of some of the economic conditions or the market conditions. Okay, so then the reversal condition. So in reversal condition, we make the adjustment. Okay, so what are the disclosure requirement under the Indian Accounting Standards 36? So what are the basic requirement? That is the event and circumstances. That is the detailed explanation of events and circumstances that led to the recognition of reversal of impairment losses. Okay, so when there is impairment losses or the reversal of the impairment losses, that event should be clearly mentioned in your financial statements. A loss amount, or okay, so I told you that is the 6 lakhs minus 4 lakhs, the 2 lakhs amount should be clearly mentioned into the financial statement. That is the quantified amount of the impairment losses and the reversal recognized during the period. That amount should be clearly mentioned in the financial statements. Okay, or the methodologies, comprehensive description of the methodologies and the key assumption used in the recoverable amount calculations and the sensitivity analysis. So all this part should be clearly mentioned. Okay, so which we can say the calculation method we are use, Okay, what are the assumptions we assume while calculating all this part of, or the we can say the implement losses. Okay, so here one real world example is taking is given to us, that is the borrowing cost and impairment. Okay, so here is one building is in the construction phase. So to build that okay, so the power plant actually we are constructing. So here in construction phase, what we do, a construction plant, a power plant construction is financed by Swiss with 5,000 crore loan at 8% interest rate. Okay, so that means the 5,000 500 cr 500 cr raised by the power plant company at the interest rate of 8% for the 18 months. So that 500 into 8%, that is the 40 cr is your we can say is your uh, borrowing cost. Okay, so the example is the combination of both, that is borrowing cost and the impairment losses. Okay, so that 40 cr is your borrowing cost. Okay, so now this market, because of the market downturn or the market conditions, that the subsequent regulatory changes and the market downturn trigger the important indicators, and the independent valuation show recoverable amount of the 450 cr versus the 540 cr. That means the actual value you put into the construction of the power plant is the 5 cr plus 40 cr is your borrowing cost. That is the total cost is the 540 cr. But after some market conditions, the market value of the power plant is the only the 450 cr. That means your carrying value is for 540 cr, and your recoverable value is the 450 cr. That means your impairment losses is the 90 cr. So 90 cr is the impairment losses recognized immediately, and the comprehensive disclosure of valuation methodology and the assumption enhance the financial statement reliability. So all these disclosure, if the we can say that power plant is not disclose this information, so might be some of the investor may misguided because of the false information. If this we can say the value degradation, if clearly mentioned into their financial statements, then investors can take the good decision. That means as an investor, I will not invest in such type of company or the such a type of power plant, whatever it may be. So this is all about the carrying cost and the impairment clauses. Okay, so here we finished the this both these Indian accounting standard, that is Indian accounting standard 23 and Indian accounting standard 36. Okay. Okay, the we can say the we here we sum up the sessions. In next sessions we some see some another Indian accounting standard. Okay, till if you have any questions, or otherwise we will end the sessions here. Okay, just a second. Okay, thank you, students. You can join your next sessions. Rohit sir, please end the session. Rohit sir, please end the session.